chapter number 1. Yeah, the overview of financial management. And then if you remember very well, we said that this finance manager, once he takes up an assignment in this company, he has to look for money needed to finance projects of these companies. Most of these companies, of course, they don't have money of their own. Even if they had money of their own, it wouldn't be sufficient. So all the time, they'll be thinking about, we have this project that has a budget of 100 million, and we can only finance 40 million. How about the 60 million? Do we get debt? What do we do? Do we squeeze our existing shareholders to even give more? So those are the kind of decisions, ladies and gentlemen, that we shall be looking at in our second chapter, chapter number 2. So chapter number 2 is what we call the financing decision. If you look at your syllabus, I hope you guys have your syllabus. This is what we call the financing decision. How do we finance our projects? So 2.1, nature and objectives of the financing decision. All right? Yeah. So we are told here, the financing decision deals with how an enterprise raises capital to fund its operations and growth. It aims to determine the most appropriate source of funds while balancing cost, risk, and control of the business. When we talk about control of the business, ladies and gentlemen, assuming, for example, today I'm the only owner of RCM. And of course, we reach that point where I feel that, hey, we need, in this case here, extra funds. So if I say we need extra funds, and then I decide to bring in shareholders, to buy shares, then I will lead ourselves, in this case here, the existing shareholders, we shall be able to experience what we call diluted ownership. And when the ownership is diluted, it means automatically that we shall lose control of running the company. Yeah, so in this case here then, what if, for example, we wanted 100 billion, and then as a firm we say, hey, let's borrow everything, let's get debt. How about the risk of us not being able to repay back the debt? If you're not able to repay back the debt, then that will automatically mean that whatever asset we had used as collateral, we lose it. So we must always try to look at the risks, the costs, vis-a-vis the control. Please, this theory, ladies and gentlemen, is very, very popular in your exam, as you shall be seeing. Remember the way I normally teach this theory? Yeah, so first of all, I give you the background, and then down here, you'll be able to see the practice questions from our various past papers. That's why I want you to be very, very, you can see there are like 9 of them, or even more. Yeah, you have to be very, very keen to be able to get up everything that I'm teaching in this background part for you to be able to answer most of those questions even without my intervention. So we're looking at this 2.1. So then we are told here, key objectives of these financing decisions. Our aim will be to minimize cost of capital. Yeah, remember that those sources of capital which are very, very expensive. I won't want to be the finance manager who will be advising my company to go for Shylock money. Yeah, we have to play around. How do we minimize our WACC? How do we minimize our cost of borrowing or cost of raising this capital? Select the financing option with the lowest cost while ensuring sustainability. If, ladies and gentlemen, you are borrowing from Shylocks, of course, that kind of business model will not be sustainable. The longevity of this company will not be there. And then we are told, in this case here, second, maintain financial flexibility. Ensure the business can access funds when needed without over-commitment. Yeah, we should be flexible. So in this case here, if you have taken a loan with a bank, then we should be able to negotiate with this bank that whenever we have surplus monies from our business, please allow us to pay you up. And whenever we need extra, we need a flexible model. You know, like initially, those of you who are a little bit old, you know that initially, ladies and gentlemen, whenever it came to mortgages, people would give you a 30-year mortgage and they would not want you to accelerate payments. They would not want you to pay them extra. They wanted you to stick by their program, all right, which made it very, very inflexible, very, very costly. Yeah, optimize the capital structure. balance between debt and equity to achieve the lowest WACC. Ladies and gentlemen, between debt and equity, which one is the cheaper source of finance? Anybody, ladies and gentlemen, who could answer me that question? Between debt and equity, which one is a cheaper source of finance? Remember, as I wait for you to answer, the debt holders, we pay them interest. Yeah, and the interest that you pay them is tax allowable. You'll be able to go and charge it in the income statement. It's tax allowable. Yeah, because of that, then debt will always be seen to be cheaper. Yeah, equity owners, the owners of the shares, we pay them dividends. And dividends can never be allowed for tax minimization purposes. No. The other objective of seeking for this optimal financing decision is to help us manage our risks. So as much as debt is cheaper, it's quite risky. It can easily get you into insolvency. So limit exposure to financial distress and insolvency risk. Maximizing shareholder wealth, financing decisions should align with long-term value creation. Now, what factors should I consider when I'm making a decision of which vehicle do I use to finance my business? Factors to consider when making financing decisions: the nature of the business. There are businesses naturally which are capital intensive, like they're telling us here manufacturing. Yeah, setting up the plant, setting up the warehouses. Here automatically will need more capital compared to service organization like, for example, RCM. What capital would we really need? We are teaching using a very cheap camera. We are teaching, in this case, using Zoom, which costs us almost nothing. Yeah, so the nature of the business will really matter. It's a factor that we have to consider when making financing decisions. Size of the firm. Generally, larger firms have greater access to diverse financing sources, while small firms may rely on trade credit or bank loans. So size of the business, yes. Legal form of the business. Incorporated firms can issue shares and bonds, unlike sole proprietors or partnerships. So you're coming in as a finance manager, then you ask them, is this a company limited? If it's a company limited, it will have quite many ways of raising funds. Yeah, you can issue bonds yourselves. Yeah, you can go to a bank. Yeah, so the legal form of the business is really important whenever it comes to this business finance. Then we have business cycle conditions. Financing strategies vary depending on whether the firm is in boom, recession, or recovery. Yeah, so ladies and gentlemen, for example, during COVID-19, early 2020, banks could not give organizations loans. So of course, that was a recessionary period. Yeah, when it's recessionary, then in this case, you are left with no option other than calling the owners of the business, tell them, hey, now you must give us equity. So the business cycle conditions, ladies and gentlemen, very, very important. And then we have, in this case, the cost of capital. Firms must compare between alternatives to minimize the overall WACC. We have control considerations. When you are issuing shares, equity, you are losing control. So issuing equity may dilute ownership, while debt preserves control but increases risk. Economic environment. Ladies and gentlemen, like right now, the interest rate is not that high. Yeah, given what the government is doing. Remember, the government has been able to reduce their treasury bill rates. So as they reduce them, then banks will be outside here looking for people to give money to. Because you see, initially, you realize that the banks were only going for government because government would give them interests of up to 16%. Yeah, so whenever we have a very, very tough economic environment, and then the government wants more money, the government will give a higher rate. And then, of course, in this case here, the businesses outside here, you'll be left with no much flexibility. Because if banks can't give us money, because the economy is very, very bad, then what do? We'll be forced to tell the owners of the business, for this business to continue, you guys must support it. Yeah, economic environment, high interest rates, inflation, or unstable exchange rates influence financing choices. And then, of course, we have the tax environment. As you've said, if you are after minimizing your tax obligation, then you go for debt, because debt will be able to give you a tax shield. Availability of tax shield, e.g. interest deductibility, favors debt in many jurisdictions. Yeah, so this is really important. What do I have to consider when making a choice between debt and equity? Ladies and gentlemen, of reading here, I'll consider so many things. Yeah, I will consider in this case the macroeconomic factors like the interest rates, etc. When interest rates are very high, then I'll be able to go back and tell my shareholders, no, please give us money, give us equity. I'll be able to look at the tax implications. When I choose debt, ladies and gentlemen, I expect to reduce my tax liability, because debt, we pay interest on it. And interest is tax allowable. Ladies and gentlemen, I will have to consider security. Yeah, if I don't have security, this is a new point. If I don't have security, then I don't have possibilities of getting debt. All right? I'll have to consider the available capital markets. You know, there are countries where capital markets are really, really down. For us here, we have the Nairobi Stock Exchange. It is really huge. So if that possibility is there, then I can go there and raise money using, in this case here, a public offer. I offer my shares publicly. For example, we could decide to list RCM. Then we have, of course, the concept of minimizing what here? WACC, cost minimization, the minimization of cost of capital, like that. Those are some of the things I would expect you to look at. And then, of course, you must put yourself in that position where you are looking at yourself as if you are a finance manager. Finance manager will be able to answer most of those points very, very easily. Sources of finance for businesses. We have, of course, as a business, you've made profits. We expect you to have retained earnings. So A, internally generated funds. Examples, retained earnings, sale of assets, working capital adjustments. Advantages, if you're using your own internally generated revenue, you'll not be able to dilute ownership. Yeah, there'll be no repayment obligations because of debt. Yeah, no dilution of ownership, because remember here, you're not going to invite in new shareholders. Disadvantages, limited availability. Which company will be having? I've done financial management for so long. I run an audit firm by the name of 𝐨𝐟𝐟𝐞𝐫 Company, which is based at Westlands, Havenscott. You can pay us a visit if you have the time, whenever you're around Westlands. Yeah. We look at balance sheets of many companies. We look at income statements of many companies. It will be very, very hard for you to get companies in this economy that are having serious retained earnings. So if you're looking at this retained earnings as a source, please always know that there is that limited availability. Then we have now externally generated funds. Funds that you're going to raise from outside there. This will be equity funds where you are selling shares. This will be debts. This will be preference shares. Yeah, so long-term sources, equity, shares issued to investors. Yeah, the advantage is that it's a permanent source of capital. They are not redeemable. Somebody will not come telling you that, hey, take your shares now, give me back my money. If you're tired with my shares, go to the secondary market, like the Nairobi Stock Exchange, sell to another person. That's why you call them secondary markets. The primary market was closed a long time ago. Yeah, no repayment obligation, because this is not a loan. Yeah, in this case here, the cons, the disadvantages, of course, when you raise money using equity, you're going to issue shares to new investors. So the ownership will be diluted. Yeah, and then when you pay dividends for these, they are not tax deductible. Then we have debt. These are long-term source of funds. the loans, the bonds. Yeah, borrowed capital, repayable with interest. Advantages, interest is tax deductible. Should I go the loans way, I'm not bringing in new investors. So there is no ownership dilution. Disadvantages, repayment. For those of you, ladies and gentlemen, who have loans, you can cry with me because I also have loans. I believe in loans. I can't operate without loans. But whenever it comes to repayment, there's that mountain that you have to climb. There is a high risk that you may easily become financially distressed. Yeah. And then, of course, we have what we call the hybrids, e.g., convertible bonds. Is there somebody who knows what a convertible bond is? Anybody who has ever heard of a convertible bond? So a convertible bond, of course, is a contract, yeah, which shows that you have given a certain company money. That's a bond. Yeah, a contract showing that 𝐨𝐟𝐼R𝐴 has given RCM money. An enforceable contract. If they don't repay me back, I will be able to take them to a court of law. And then, of course, I ask them for my payment. If they can't, after I've taken them to court round, I can ask for winding up of the company. All right. So, ladies and gentlemen, when it's convertible bond, it means that at some point, if I feel like I want to become a shareholder of this company, I can trade in. I can trade in my contract, bond contract, with shares. That's convertible. Yeah. Preference shares. So we have their mix of debt and equity what here? Features here. So even preference shares, of course, they will be the convertible ones. Then, ladies and gentlemen, to raise these long-term funds, we have what we call lease finance. And I would really advocate for this lease financing, ladies and gentlemen. If, for example, you want to start a school, yeah, it will be very expensive for you to start buying land. You go and lease land. When you lease, it's like you have been given that entire asset as a loan. You pay for it, in this case, just slowly. You pay what we call lease charges. If you had the story of Ndini Nyoro the other day, yeah, he was against really people building these big apartments. I mean, ladies and gentlemen, most of these things you are building up here, you shall never recover back their initial cost. So according to him, you would rather have that 30, 40 million Kenyan shillings, put it in a money market fund, and then start getting like 400,000 every month. So instead of building your own home, yeah, which will cost you 40 million. If you take 40 million to a money market fund, at the very least, you're guaranteed over 400,000 shillings every month. Then these 400,000 shillings every month, take this money, go and lease a building, lease a home, stay there, and be paying like 150. Yeah, the other 250 now, which is on top, you can be doing a few things here and there with them. To counter, somebody will come and tell you that, hey, if I bought this place, build my own building, then I'll be enjoying capital appreciation. But you see, I also have the 250 that I'm also working with. At the end of the day, ladies and gentlemen, leasing works magic. It works magic. And then remember, when I lease, I will be able to get tax advantages, especially if I've leased business premises. I'll be able to get that as a big advantage. Then we have, ladies and gentlemen, venture capitalists. You must have heard of these venture capitalists. Like right now, there are so many. Like on this Wednesday, I'll be receiving some venture capitalists, in this case here at my office, yeah, at Commonwealth House. Why? Because we are doing lots of marketing online. So by doing lots of marketing online, there are those sharks. They're able to see business opportunities. So they want to come and tell me that, you know what, if you sell shares to us, yeah, we shall be able to buy, of course, shares, and then we pump in capital. We become, in this case here, shareholders as well. And they give us a board position. They're called venture capitalists. It's venture capitalism or business angels. Business angels, so financing from investors in exchange for equity and mentorship. Yeah. Then we have private equity, capital provided to mature companies for expansion, restructuring, or buyouts. Remember, private equity, they share the same characteristics with these venture capitalists, except for the fact that these venture capitalists, they come in at those infancy stages. Private equity in this case here will be looking for an organization that has been there for 15 years, 20 years, etc., which is doing very well. But this company wants to expand and they're not able to expand at the moment. Then we have asset securitization and the sale, converting assets like receivables into tradable securities. Ladies and gentlemen, remember asset securitization, all right? You must have heard of asset securitization in the name of what here? Dr. Ruto's government. Yeah, they did securitize fuel. Yeah, because they know that we now have government to government. Government is the one that is selling fuel, in this case here to Kenyans, indirectly, of course, indirectly. So they're able to project cash flows, which will be coming from this particular water fuel. And then they go, of course, now contractually get money from these Arabic countries. So it is securitization. For example, how you would go and look at Kenya government has the express highway. Yeah, that express highway. So they're able to project cash flows. How much cash flows will we be able to get? Now, using the projected cash flows in form of a business plan, they go and borrow money against this express highway. They are making the express highway a security. They are doing securitization. They make it a collateral. Yeah, and then in this case, they are able to do what? To get either, they get cash flows to finance other ventures. So whenever we talk of asset securitization and sale, it's basically converting those assets. It could be receivables. It could be, ladies and gentlemen, it could be, ladies and gentlemen, buildings. Yeah, the moment in this case here, you have those buildings and then you securitize them, especially if they're having like rent, cash flows. You securitize them, then you'll be able to get what we call tradable securities. Yeah, and the moment in this case, they're tradable, like Kenya government, you sell immediately and then you get money to build roads. And then now you'll be able to pay contractors. And now people will be able to see that you are very busy building roads all over. And then they'll say this guy should come back in 2020. But you see, somebody like ourselves, who knows how these things operate, we know that they have done what we call securitization, which basically is mortgaging the country forward, in this case here to our great grandchildren, to come and pay debts over assets perhaps they never enjoyed. They were never even consulted. Then we have Islamic finance. You know, Islam, ladies and gentlemen, they don't believe in interest. Interest is haram. So we have a Sharia compliant financing. So then when they give you money to go and build some apartment, they expect you to come and say, out of this apartment, out of whatever money you gave me, we've made this profit. So in this case here, we share profits instead of what here? Interest. It's called Islamic finance. Yeah, Islamic finance. Very, very important. And then we have the initial coin offerings. Remember ICOs, ladies and gentlemen, you can easily securitize your coins. Yeah, if you remember this concept of what here? Bitcoins, for example. You should be able to learn this. Yeah, you can easily securitize this, and then you raise funds through blockchain tokens. Yeah, remember, it's about raising funds. Medium-term sources. Medium-term to us in finance, it means 3 to 10 years. Yeah. So then we have higher purchase financing. I hope you know what is a higher purchase, eh? Yeah. Then we have short-term sources. Yeah, like, before we were able to, ladies and gentlemen, break through as a college, we used to work with overdrafts. You know what is an overdraft? You are able to overdraw your account. So your account doesn't have money. You go and talk to a bank, tell the bank that come end of the month, we are supposed to pay our employees, and therefore allow us to overdraw. We draw even what we don't have. That's called an overdraft. It's never long-term. It's recordable by your bank anytime. We have trade credit. Yeah. So the trade credit, of course, will be able to, get like a bank. Yeah. That will be able to facilitate this trade that I'm getting in this case here, this contract to supply this. So please give me some money. I do this trade. And once I'm paid, I pay you back. Yeah, we have commercial papers. If you remember these commercial papers, we have bonds. Bonds are long-term loan instruments. Commercial papers are short-term, loan instruments. In this case here, for example, you could also choose not to pay your workers. Like we know, I mean, even the government here is not paying some workers, right? And then you are able to do what, to raise funds that way, to do other things. Although this is really bad. Using accruals here to finance your operations, like what they're doing with pending bills. They're not paying the bills. So accruals, e.g. unpaid wages, even taxes, you can accrue tax and use this money to do other things. Deferred income, advance payments from customers. As per IFRS 15, you can ask your customers, in this case, to pay you upfront. Remember, ladies and gentlemen, as a finance manager, you are not supposed to be fearful. As a finance manager, whenever you are in problems, you can even go to your customers and tell them that, hey, you know what? If you are in a position, please pay me in advance. Of course, it's going to cost you some reputation, but at times, it's better for you to do that than being wound up. So I hope this description is helpful, and then I'll be able to continue. So we have here evaluation of sources. Evaluation of sources. Cost implications. Availability. Are they there? Availability. Impact on control. Risk exposure. Default. Liquidity. Evaluation of financing options. When evaluating finance options, finance choices, firms consider cost of finance, compare effective cost, interest rate, dividend expectations, flotation costs, etc. Remember, there are those particular options. Whenever you want to raise money using them, you will have to even, mount on top of even some vehicle. You start dancing in the name of marketing securities. You must have seen this happening. You are advertising them on the newspapers. Flotation cost can be very, very high. You see, especially if you are floating these to debt holders. They would want you to convince them a lot. But if you're trying to raise money from your equity, the equity owners, will be easier because they already know you. They already know your future prospects. Chances are it would be really that costly in terms of what flotation costs. Then we have impact on capital structure. If I bring in equity, then I reduce my gearing. If I add more debt, my gearing ratio is going up. So then anytime I'm choosing between debt equity, I have to look at the impact on the capital structure. Risk implications, the default risk, business cycle stability, flexibility, whether the option allows early repayment. This is very, very important, ladies and gentlemen, being that I'm a heavy consumer of loans. Is there somebody here like myself who believes in loans? Who believes that loans are good? Anybody who believes that loans are good? Anybody who believes that loans are good? Anybody who believes, these guys are not talking to me today, I don't know why. Ladies and gentlemen, loans to me are very, very good. They are very, very, very good. I can't operate without loans at any given time, and I'll be able to tell you why. I'm doing quite many projects at the same time, and I've done this, as I told you in some other class. I've been with these international firms for so long. Debt capital will give you leverage, will give you what we call leverage. I hope you know what a lever is. A lever. That fulcrum, if you're doing that seesaw. So once in this case here, you are gearing. It gives you a push. So whenever you're given debt, and then of course you know how to use debt, ladies and gentlemen, you will go very, very far. There is not a single rich person, billionaire, in dollar terms, who doesn't have debt. Because debt is about optimally using other people's money to create profit for yourself, to create wealth for yourself, and then you return back that money, right? Although you must be very frugal. Don't be like a friend of mine some time back. This guy got some money. I can't remember how much exactly. Talk of, say, 1.8 million, maybe 200. So in this case here, whatever. 1.82, whatever. So this guy was telling me that, Mwalimu, you come over here, we take up something. Come over here, we take up something, ladies and gentlemen. So I was asking this ninja, what do you want us to take up? So he was telling me that, you know what, I've gotten a loan. But this loan has got suckers. You know suckers, eh? Yeah. So if this is the tree, ladies and gentlemen, so in this case here, it has suckers. Yeah, these are the suckers. So he's calling this 200,000. In this case here, what here? Suckers. So he wanted us in this case here to meet, and then we do what here I told this gentleman that he wanted to be left with just the branch. He wanted to be left with the branch. Yeah. So in this case here, the suckers, he was calling this suckers, he was calling this 20,000 here. But let's finish this. Loans don't want jokes. Loans in this case here are for very, very serious people. You can't be alcoholic and then you work out effectively with loans. Let me tell you something. If it were not for the loans, like for example, that we took to construct our primary school around Kitengela area, yeah, I'm 100% sure, given that I'm not a very, very poor man, I wouldn't be here today. Today is a Sunday, teaching you. So I would want in this case to put in lots of efforts to ensure that we bring in traffic to enable us in this case here pay what here our loans. I can assure you, most of guys, my age mates, who never took loans for development, most of them, because they have a salary which is not committed, what are they doing today? They are somewhere imbibing things. So loans in this case here will teach you to be very, very focused, especially if you know how to borrow optimally, and then, ladies and gentlemen, how also to invest. Yeah, and then of course the fact that this is not something that you take and then we start seeing you and your wife and your children wearing new clothes simply because you've taken a loan. I would take a loan of even 80 million and I'll be walking in this town like just a normal person. I mean, nobody will even be able to know. They'll just call me teacher, teacher, teacher. But I know loans are not bad because they'll be able to give you some gear. They'll be able to gear you up. They'll be able to give you what we call leverage, like that. Yeah. So normally what I do, I will borrow heavily. When I start making profits, what do? I start now straight away investing the profits in money market funds. Money market funds are very good. I start taking the profits in this case here where to, yeah, for example, SACCO, savings and credit. Yeah. And then of course, the repayment of the loan should be carried over by the new entity. If it's school that we put up using this loan, then we expect it now after say 1 or 2 years, it should be able to carry that loan on itself. Whenever it makes profits, I'm diversifying. Even after I diversify fully, after some time, I will not allow what we call discharge. Discharge of properties, no. It'll reach a level where I tell them, add. Why? Because I would want to increase my assets. Because I would want, by the time I'm hitting, say, 55, we should be able to have a very serious, a fully fledged, training institution that is running from primary school, secondary school, college, and even university. For me to be able to do that, then I must stack up assets. How else do I stack up assets if I don't have loans? So in this case here, loans will make you to be waking up at even a time that, you will not believe it. So long as you use it optimally, then of course you must also ask for God's favor, because you can also be very good at using this money. But you see, there is a risk. You borrow and put it in a venture, and then that venture dies. All right. So then allow me to, Mwalimu has it, great. We shall overcome. Oh, the handout, yeah. The handout will be giving you the handout. Don't worry about the handout. Great. But the most important thing, are you guys able to get to what I'm talking about here? Because also when I teach you financial management and I teach you advanced financial management, I expect you to be financially literate. So I'll be telling you out of my own experiences, the steps that you need to work on for you to become what here? Successful outside here. Successful outside here. So whatever I'm telling you here, ladies and gentlemen, is not something that is fantasy. I'm not fantasizing. It's something that I've gone through. Now they're able to follow. Great. So we continue. But of course, I know like Omar will tell me that Mwalimu, I don't want a loan. Why? Because Omar is Muslim. And of course, he'll tell me now as a Muslim, interest in this case is haram. But you see, Omar, you can get a loan from an Islamic compliant bank. They have a way. Yeah, they'll be able to get their return through the profit sharing models. The God shall be discussing here, Musharaka, Muduraba. All right. Yeah, in a way that you will be, as you please yourself, You're also pleasing what? Yeah, God, but we Christians, anything, even interest is good. Yeah, great. Great. Yeah, Sharia, yes. All right. So whenever you're evaluating, ladies and gentlemen, these financing options, you'll have to look at cost of finance, impact on your capital structure. We have risk implications, flexibility, control implications, market conditions, availability of funds, investor appetite, prevailing interest rates, tax implications, debt interest deductibility, and non-deductible dividends. This is very, very common. Methods of issuing ordinary shares. Now, ladies and gentlemen, over 20 years ago, we had Safaricom coming to the market. Remember, Safaricom used to be part of telecom. It used to be a department with the telecom. And then they were able to hive it off telecom. And then they brought us a new brand, a brand new company, told us this is Safaricom. Now we want you to finance it, the public to finance it. So they did raise funds through what we call IPO, initial public offering. Initial public offering. Initial public offering. Yes, you can succeed without taking loans, yes. So then we have here methods of issuing ordinary shares. We have public issue, shares offered to the public through a stock exchange, initial public offering, IPO. Yeah, you know, there are those companies, that will be going to the market for the very first time. Like if RCM, for example, wanted to list at the stock exchange for the very first time, then this will be an initial public offering. Then we have private placements. There are people who don't want noise. They want to get money from the market, but from Nairobi Stock Exchange, but they don't want it to be public. So in this case here, you can invite a few of the investors, to come and give you money through a private placement. Shares issued to selected institutions rather than general public. Then we have bonus issue. So bonus issue, these are free additional shares issued to existing shareholders, capitalizing reserves. So the gentlemen, remember, when you are a finance manager, and it's good that I'm seated with the people here who will become the very best finance managers of these biggest institutions in East Africa. When you are a finance manager, you must always think of raising funds every now and then. And one of the ways of ensuring that you shall have your wheel of raising funds rolling, it reaches February, you invite, in this case here, the shareholders, tell them that we have some bonus shares. Yeah, script shares. So coming to give you shares without you paying anything. They're for free. So of course, they will be very happy now that for everyone share you have, they're giving you 5. Yeah, they are very, very happy. Yeah. Then after now, these shares, of course, become many. After some time, now issue a give what we call a rights issue. So rights issue, you are giving shares to existing shareholders at a discounted price. But now you see money will be coming in. And now you're going to fetch more money because now these shareholders have even more shares. So like bonus issue, somebody may ask, Malim, why should I issue these bonus shares and yet I'm not going to get money? You don't look at these issues today. There is a possibility that they will be having now many shares. When they subscribe for any rights that you give, automatically you're going to get more money. Yeah, more money. All right. Then we continue. Yeah, and then we have what we call a rights issue. Existing shareholders are given the right to buy additional shares at a discounted what-year price. Yeah, at a discounted price. Then we have the ESOPs, very, very popular, employee stock option plans, shares issued to employees as part of compensation, aligning interests with the company's performance. Ladies and gentlemen, as RCM, if you want to really, really go far, it will be very good for us to have our teachers and the support staff wishing the college all the best. And they can only wish this college all the best if they have a stake. in the name of shares, so that in the future, when the share price goes up, then when they dispose, they'll be able to get more money. So the moment in this case here we give them some shares, then their interest and the interest of the college will be very well aligned. Yeah. So we have what we call employee share ownership schemes. Yeah. So you can simply start by telling them that you guys, we have this like 10%. You start now, in this case, you're paying for them. So it's really at a discount. ESOP or ESOC, employee share ownership schemes there. Very, very important for you to start thinking about empowering your staff. But remember, there must be a quota. Yeah, you can say, for example, they can buy up to 25% or 30%. Because if you leave it again open and then they get majority, they get 51%, they can throw you out as the founder. So you must cap it somewhere. You can only allow yourself to take lower shareholding when a company is trading its securities in the public. Like if you look at James Mwangi, they own about now 6% or even less of Equity Bank. Most of this, even Zuckerberg, Safaricom, you'll be surprised. In this case, he has, not Safaricom, but Facebook, he has less than 10%. Because you see, when they are going to trade at the stock exchange, what would that mean? They can never allow a single shareholder to have a lot. So even if you have 2 or 3%, you'll be among the majority and you're going to become a manager. You're going to become a director in that company. Yeah, so we have here Kevin, where they can buy shares of RCM. We shall be there. Actually, we normally keep on telling our potential investors that we shall be the first college, the first training institution to have our shares listed at the stock exchange. We don't want to go the Strathmore way, where you really have like a highly private college for Catholic. No, we would want in this case here a big thing that is owned by many people, a public listed company. And then of course it should be, we have great ideas at RCM. Like the other day I walked to Alliance High School. In this case, I told Alliance High School, everybody outside there would want Alliance education. I told Alliance High School, let's have a joint venture between RCM and Alliance. So for us, what shall we be doing? We shall be coming to your classes. Whatever Mwalimu is teaching in class, we simply zoom that out too. And I'm telling you, and then of course I was to partner with Kenya National Library Services. Yeah, to take in this case here, those big screens. Yeah, all over like that. And I'm so sure would have generated billions and billions, but those guys now could not see the essence of what I was telling them. Yeah, so for those of you, of course, those are the kind of ideas. Partner with even Akina Harvard to bring in this case here, even University of London, to bring in this case here the education to Africa. Yeah, and then of course that will be a game changer. When we reach that level and then we advertise very well, then we shall be able to really have a very big publicly listed college. Yeah. Yes. All right, ladies and gentlemen, then I continue here. So, of course, now we've finished that. Then now we go to the past papers and I like for especially these theories to do like, talk of 9 questions, 9 to 10, from 8 to 10. Every chapter, that's what I do even in the computational chapters. We do 8 to 10 questions. Yeah, that is the essence of what here? Special revision. Special revision is not like the normal class. No, I just give you a preamble, small, little practical things, and then I go to the questions. Ladies and gentlemen, look at this December 2023. Many students were not able to answer this question. December 2023, question number 5B. Summarize 4 distinct features of commercial paper as a short-term source of finance. Remember commercial paper, I told you up there? Bonds are long-term, and the commercial papers, we use them to raise funds for the shortest possible time. Yeah, so it's a contract to raise funds in the short term. That's a commercial paper. So they wanted us, ladies and gentlemen, in this case here, we give them 4 distinct characteristics of what here this commercial paper as a way of raising what here finance. Of course, it is a short-term money market instrument. It's short-term. Less than a year. It is short-term. Yeah. usually in the form of a promissory note with a fixed maturity. So in this case here, when I have this commercial paper, having given RCM Joshua Ura, having this commercial paper, which is a contract, having given RCM 10 million Kenya shillings, so in this case here, I have a promise now from RCM that I'll get 10 million Kenya shillings plus interest. Yeah, so in this case, ladies and gentlemen, it has fixed maturity. It serves as evidence of an unsecured debt obligation. Now remember, if it's commercial paper short term, ladies and gentlemen, just like overdraft, we don't involve collateral. So it is evidence of an unsecured debt obligation. It is typically issued at a discount, but may also be interest bearing. Please listen for those of you who have ever invested in treasury bills. So you'll get a treasury bill. Yeah, this promissory note is written 1 million. It's written 1 million. Yeah, just like, for example, that 1,000 note, that's how they look like, written 1 million. And of course, the name of the issuer, your name, like that. So there are two types of T-bills, or let me talk about commercial papers, two types. There is a discounted commercial paper. A discounted commercial paper, out of the 1 million written on my contract, I will give them much less. For example, I can give them 700,000. So myself, I've given them 700,000, but upon redemption, they give me 1 million. Upon redemption, they give me 1 million. So the difference will be my interest, on top. Yeah. Remember, there are companies that really fear these monthly interests. They fear. They will tell you, these are commercial paper, you're giving us 1 million Kenya shillings for 1 year. We don't want to see you here until December. Give us time to look for this discount on top. Yeah, then you go. That's option number one. Option number two is, of course, a commercial paper. I gave them, for example, 700,000, and then every month they're going to be paying me a principal, which of course, or rather an installment, which of course has a principal and interest. So commercial paper, if I were you, in most cases, they are deeply discounted. They don't carry what year? Any interest. They don't carry any interest because most of them are deeply discounted, and then that discount will be your benefit. All right. Ladies and gentlemen, here we are. The issuer guarantees repayment of a fixed amount in liquid cash without pledging any assets. Remember, for commercial papers, it's about liquidity. You must pay back in cash. Commercial papers may be issued directly to investors or through what year? Dealer banks. Through dealer banks. Ladies and gentlemen, the points that I will never forget about these commercial papers, which are really, really common, please listen and listen to me very well. In terms of characteristics, what will I never forget myself? What will I never forget myself about these commercial papers? Characteristics. The characteristics of these commercial papers. So number one, they are short-term in nature. You don't have to write them the way they are written by those guys. Short-term in nature, less than a year. All right. The number two, ladies and gentlemen, they have in this case here a fixed maturity period. I will never forget this, a fixed maturity period. It can never be rolled over. Remember the bonds, which are normally rolled over. For commercial papers, they can never be rolled over. Then number three, ladies and gentlemen, in this case here, the benefit is a discount. They are issued at what year? They are issued at a discount. And then in this case here, number four, these particular commercial papers can be issued directly by the issuer to the client, by the issuer to the lender, directly. Yeah, and then of course, having this commercial paper, ladies and gentlemen, at the end of the day, this is pure promise that I'm owed. Yeah, it's a contract. So it's pure promise that I'm owed. So I hope you'll be able to remember some of those small points. So let me share this. Yeah. So then we come here, ladies and gentlemen. That's August 2023. Question number 1, A and B. So outline 4 limitations of profit maximization as a financial goal of a firm. I taught you this yesterday. When you put forth profit to be the biggest thing in life, yeah, what are those disadvantages? So outline 4 limitations of profit maximization as a financial goal of a firm. Yeah. So it is unclear, first of all, which type of profit should be maximized. Should we maximize gross profit, operating, or net profit? They don't define for us. These profits, of course, will always ignore the concept of time value of money. It focuses on short-term gains, conflicting with the going concern principle. It doesn't regard any risk or uncertainties. Yeah, you will never, when you know it's profit calculated by the accountant, the actuarial who looks at risks so much does not even come in to give a report. So it disregards any risks and uncertainties associated with returns. It overlooks social responsibility and stakeholder welfare. Ladies and gentlemen, remember yesterday, I taught you something very important. Yeah, it is called stakeholder theory. It is called stakeholder theory. That, for example, when we run this college, RCM does not belong just to the owners, to the shareholders. No. RCM, we have students. RCM, we have the government. RCM, in this case here, we have suppliers. We have, so many. So in this case here, RCM should be able to work in the interest of all stakeholders. Whenever we are choosing profits only, that is a greedy model, because you're only choosing to serve the shareholders. So when you choose to serve the shareholders alone, then, ladies and gentlemen, number 1, you are going to disregard anything to do with corporate social responsibility. You're going to disregard anything to do with what here? Employee capacity building. You'll never take them to classes. Ladies and gentlemen, when you talk of just profits are short-term. You're encouraging what we call short-termism, and yet we would want this organization to be there in the long term. Long term. All right? And then, of course, don't forget issues of what here? Time value of money. It doesn't take into consideration the time value of money. Ladies and gentlemen, if it's profits model you're looking at the end of the day, they disregard all the risks. There is no risk management when you're computing profits here. All right? And then, of course, the fact that the proponents of profit maximization, they never told us which profit would they want us to maximize. Is it the gross profit? Is it the bottom line, the net profit? They never told us. So whenever they talk about disadvantages, always remember those particular points that I've been able to raise here. Don't forget also the fact that it ignores all the qualitative factors. Like customer satisfaction, it ignores that. Employee motivation, it ignores that. So the moment you've raised those points, then you'll be okay with your examiner. You'll be okay with your examiner. And then, ladies and gentlemen, I forgot to tell you, ladies and gentlemen, that this is your CPA Chief Ninja who will be taking you through the special revision classes. And then most importantly is that if there are any new students who would want to join us, please, this is our number. Please do not hesitate to join this #1 college in Eastern Central Africa, 0793 555 000. And all the RCM students, I want to take this opportunity to really recognize you, to really thank you. The kind of referrals you're getting from outside here, they are unprecedented. I want to believe this semester, each one of you must have recommended at least one. Yeah, because it's like we may get double population. Yeah, even myself, I'm overwhelmed. So that is, of course, thanks to our existing students. So much salutations from the CPA Chief Ninja. Great. Then we continue, ladies and gentlemen. We are continuing, we're almost finishing. Yeah, question number 2B. Evaluate 4 features of preference shares as a source of capital to a firm. Remember, ordinarily, ladies and gentlemen, in this case here, we have 3 major sources of capital. We have what we call equity. We have what we call, in this case here, debt. And then we have preference share capital. Preference share capital. Preference share capital. So whenever they ask about the advantages of you giving your money through preference share capital, number 1, of course, it will have a fixed return. Whether a company is making losses or not, if I'm a preference shareholder, I have to get my money. It has what we call fixed returns. If it's 10%, it's 10% of the money I give. The other thing is what we call the residual interest. In the event of, for example, the organization, in this case here, collapsing, we shall be able, if there are profits which are available, before these guys take, that's why I call it preferable. Preference shareholders would rank up there. Will rank up there. We shall be able to get much more than the equity holders. Not to forget other features like maturity. These preference shares, of course, will mature. Remember, equity, in most cases, they will not mature. But preference share capital, so long as it is written redeemable, you are assured at some time you'll get back all your money for you to be given another opportunity of rethinking how to invest the same. But equity, in this case, you can get into equity of both. For example, brewery shares, and then they start going down. Even if you sell them at a loss. All right? So, ladies and gentlemen, please listen and listen to me very well. Yes, thank you so much. Thank you so much, Daniel. Yes, I'll give you the handout, of course, in the paid group. Sorry, I forgot to send the MA one, but of course, I've been also running. So evaluate 4 features of preference shares as a source of capital to a firm. Maturity period. Generally, preference shares have no fixed maturity period except for redeemable ones, which may be repaid at liquidation. Remember, we have irredeemable. You can even describe them like that. Irredeemable, they don't have fixed maturity period. And then in this case here, redeemable, then they have, from the word redemption, they have a maturity period. Residual claim on income. Preference shareholders are entitled to a fixed dividend before equity shareholders. So the income, in this case here, they are entitled to their income before equity shareholders. Then we have residual claim on assets. In case of liquidation, and then assets are sold, these guys will always stand a higher chance. So residual claim on assets upon liquidation, they enjoy priority over equity shareholders. Control of management. Remember, these people are not coming to dilute our ownership. I don't know how I forgot about this. This is really important. Control of management. They usually lack voting rights, thus do not influence company management. April 2023, question number 2A. Summarize 5 factors that should be considered when making financing decisions. These ones already we have them. Nature of business. Manufacturing firms require more fixed assets, while trading firms rely more on current assets. So manufacturing firms would need more capital. Size of the firm, large firms require more capital. Legal form, incorporated firms, e.g. limited companies, have greater borrowing capacity. Business cycle, ownership, economic conditions. So the factors that you have to consider, ladies and gentlemen, whenever you're thinking about financing decisions, on top of this, I'll also consider the cost of capital. Cost of capital. Which one is cheaper? I'll consider the tax implications. I'll consider availability of, for example, collateral. If I don't have collateral, then it can only be equity. So among these points, ladies and gentlemen, and that the fact that you will be getting this video, you'll be able to read that later. Explain 4 methods that a company could use to issue ordinary shares. Already we have this: public offering, offer for sale, private placements, employee stock options. We have explained this: rights issue, bonus issue. Stock exchange introduction. Shares already issued are limited for trading on an exchange. That's neither here nor there. Question number 1D. Propose 4 factors to consider when choosing between long-term loan capital and ordinary share capital as a source of finance. Already have covered this, ladies and gentlemen. Yeah. Cost of capital, of course, we know. Loans carry interests, equity carries dividends. Repayment terms, loans require periodic repayment, equity has no fixed. Ownership dilution, issuing shares reduces existing shareholders' control. Yeah. Financial leverage, loans increase debt levels, while equity strengthens the capital base. Risk and return, of course, we know that loans are quite risky. Yeah. Market conditions, yeah, we have to look at the prevailing interest rates. These are things you guys will be reading and I've already explained. May 2021, question number 4A, outline 4 factors that could hinder the success of a rights issue. Remember, a rights issue is where you give shares to existing shareholders at a discount. So even if you're giving them at a discount, at times we have seen companies issuing the rights, yeah, at a very, very discounted price, but still it doesn't succeed. Why is that the case? Market conditions. When, of course, the market is not doing very well, people don't have money, they don't have purchasing power. Share price, if undervalued, shareholders may be unwilling to invest further. Yeah, you can imagine you're telling me to buy a rights, yeah, even if it's at 2 cents. And then I hear that at the stock exchange, even my shares are not able to sell at all. Yeah, the share price is really low. Then I know that even if I buy these extra rights, extra shares, I won't be able to get a market for the same. So the share price is very, very low. That could be a demotivator. Size of offering, a very large issue may be difficult to absorb. Timing, poorly timed rights, e.g. after frequent capital raising. Yeah. So you've been doing capital raising and then, of course, you are again heard that you're giving your shareholders rights. People suspect. Company perception, weak financial performance discourages uptake. Competing opportunity. Yeah, remember shareholders have got many competing opportunities. Like right now, people are talking about investing in money market funds. So if I have a few coins, I will not invest them back to the company that no. So competing opportunities, shareholders may prefer alternative investments. November 2017, question number 5A. Describe 3 factors that have limited the growth of venture capital investment in most developing countries. When you come in as a venturer or co-venturer, ladies and gentlemen, whatever money you give to RCM, that money, of course, is not a loan. It's an equity. You can't, in this case here, get any tax waivers. Yeah, you can't get any tax waivers. So lack of government incentives, tax regimes favor debt over equity financing. Underdeveloped capital and money markets, limiting investment opportunities. So you may come in as a co-venturer or as a venture capitalist, want to get ventures to put in capital, but the market is not ready. Yeah, people don't, the market for capital is really underdeveloped. Yeah, resistance to venture capitalist demand for board representation. People don't want. Like, why I would refuse these guys who will be visiting my office, ladies and gentlemen. They're telling you that they are venture capitalists, but they would want, in this case here, to get 51% of the college. Yeah, coming to get back that shares would be that easy in the future because they will be sitting on the board. Lack of managerial and technical expertise among entrepreneurs because they want you to write like a business plan. They want you to write like a business plan. I know with this handout and with my explanation, you guys will be able to do something over this. November 2016, question number 1. Explain 4 disadvantages of public-private partnerships. That one I know, I've dealt with it, and I know the disadvantages. Number 1, it will be the culture shock. Yeah, culture shock. So, it's public-private partnerships. Yeah, so you're coming in here, you're telling, in this case here, these guys, we are the Chinese who are building this express highway. Let's see how we can work together. So we finish doing it, we transfer it to you. So there'll be culture shock, ladies and gentlemen. whenever we talk of public-private partnerships, we have in this case here shocks in the form of objectives. Remember, public sector has a social responsibility and objective. And the private sector has what here? Private sector, ladies and gentlemen, has a profit motive. Yeah. And then remember even misalignment in form of what here? Misalignment in the form of these employees' thoughts. You know, like in Kenya, when these public-private partnerships grew, we had from some quarters of these government employees saying, hey, our jobs now will disappear. Like, for example, if you're doing private roads for the public, how about this Ministry of Roads? The 𝐨𝐟𝐟𝐞𝐫, the 𝐸𝐴𝐟𝐟. Yeah. So in this case here, the culture gap, divergent objectives between public, which is social, and private profit. Yeah. Insecurity, lack of cooperation and contract risks discourage bidders. Yeah. So in this case here, remember, you as a bidder, there is no collateral being given. Yeah. You'll be secure because you'll be told in this case here, do the road. When you've done that road under public-private partnership, you can't hold on to that road. Those guys will bring the citizen and tell the citizen that, you know what, we are opening this road. What will you do? Yeah, public staff concerns, PPPs may threaten public employees' job security. Capacity limitations, public institutions may lack expertise to monitor contracts effectively. And then part B, describe 6 steps involved in personal financial management. So personal financial management or financial planning. So first of all, gather data on financial position. What is your current financial position? Assess the situation. How are your incomes, expenses, savings, and assets? Define now new financial goals. What would you want to do when you're retiring? Education, marriage. Evaluate alternatives based on values and risk tolerance. Develop and implement a financial plan, then review and adjust the plan periodically. So, ladies and gentlemen, start by gathering data. You gather data, then assess your current situation. How comes I'm having loans from Tala branch and all these other, what's wrong with me? So assess the current situation. And then from there, you define your financial goals. Like myself, I would want to retire at 55. Yeah, at 55, yeah. So that at 55, when I retire, do I expect in this case here to live in poverty? No. I expect, of course, with my family, we should be able to live well. So just define financial goals. It could be financial independence between you and your wife. So remember, you and your wife, there will be, ladies and gentlemen, situations where you do like a joint bank account. Also, there's banks you have to run independently, and of course, everybody must be able to know. Yeah, you can't put all your eggs in one basket. So define financial goals. Then, of course, these goals will be many. Evaluate alternatives based on values. Once you have said, now this alternative is what I want, you develop it and implement the financial planning. And then you must be doing what we call monitoring and evaluation. Monitoring and evaluation. Define the term franchising. Yeah, we know like KFC, they operate under franchises. Suggest 4 reasons why franchising could be considered as an alternative source of finance to a company. You know, once I franchise, I'm a franchisee of KFC, that is a big boost because I know I will be in business from day one. Once you paint your premises with that red and put that logo, you are assured of people buying from you immediately because of the kind of marketing the franchisor has been doing over time. Yeah, so in this case here, franchising is a business arrangement in which a franchisor licenses proprietary knowledge, processes, and trademarks to a franchisee. So you give it like that trademark of KFC, enabling them to sell goods or services under the franchisor's brand. So in this case, ladies and gentlemen, we are the franchisor. In this case here, we are giving you a license as RCM. Go and open RCM in Kericho. But of course, we have these standards. We'll come and inspect. So suggest 4 reasons why franchising could be considered as an alternative. Yeah, access to established brand reduces marketing cost. You shall not be able to belabor doing lots of marketing, no. Franchisees benefit from tested systems, strategies, and processes. Franchisers provide training and support, saving resources for the franchisees. Research and development is mainly undertaken by the franchisor, reducing costs for the franchisees. So that marks the end of our today's session. It has been a big honor and privilege, ladies and gentlemen, to teach you today. So I'm looking forward to meeting you guys next week for financial management. I hope you've enjoyed the session, and I hope you have carried a few things with you. Consider also, revision for FR, SK Macharia's direct line, was it a case of over issues of shares? No. Direct line I'll be able to explain to you maybe when we meet next time. Remember, direct line was owned by this ninja who was the son of SK Macharia. So when that son died, and the father-in-law never liked the wife of this son, and now those shares in this case here were going to the wife, you know then what happened. But at the end of the day, that's not a case that SK can really win. Yeah, if I were him, I mean, this lady has a son with my son. So I have a grandchild. So, some of these things are very, very ugly. I mean, with SK, I mean, having royal media, why would you want a lot of things that after all you're old? Yeah. I'll be able to share this, Chris. Chris, I can see you here. Great. So I'll be able to share this on the paid group immediately after this. Thank you so much. Great. We shall be discussing many other things about investments later. So thank you very much. Let me now prepare for my